Welcome. On today's episode, we're going to change it up a little bit with Thanksgiving being last week, and we're going to reflect on some of the financial planning tools that we're thankful for. And also, Thanksgiving is just one of those holidays where generally you get the family together. Obviously, it's a little bit different this year with COVID. But, those dinner table conversations that you have with your uncle arguing over the cranberry sauce, kind of those financial planning arguments you get in with family, and also just some of those things as financial advisors, people try to pick our brains about when we get the family together.
If you're not throwing bows at Thanksgiving, you're not doing it right.
So. Yeah. I'm Abrin Berkemeyer.
I'm Tyler Hafford.
And this is Financial Discretion Advised.
Welcome, everyone. Thanks for joining us. I hope everyone had a nice Thanksgiving. We're recording this after Thanksgiving. But since you're full on turkey and starting to hunker down for the holidays, you can find us on YouTube, any podcatcher. Find us, Apple, Google, Spotify. We're out there, but definitely check out the videos. We're going to start getting a little more interactive in the videos and want people to pay attention on YouTube. So like us, share, leave some comments. We'd love to see what you guys are thinking. But like Abrin said, we're going to talk about, what we're thankful this year in financial planning and kind of what comes up around the table. But Abrin, let's start with just how was your Thanksgiving and what are you thankful for?
I'm thankful that, with smaller Thanksgivings, you have just about the same amount of food. So there's a lot of leftovers in the household.
Yep.
A lot of turkey. I know we were talking before the podcast. You also have a surplus of turkey hanging around.
Yeah. Yep. I cooked a bird for 14 people and we had 4. So
exactly.
I'm putting turkey into everything.
Yeah.
Awesome. And I hope everyone out there listening had a great Thanksgiving. I know this year's strange in the way that things are going, but hopefully everyone's safe and healthy and had a nice Thanksgiving. But let's kind of kick off and chat about some of those things that come up at the table when you're at Thanksgiving talking with your relatives, because everyone has different things going on in their lives in their financial pictures, and there's always some questions that come up. So Abrin, I'm sure with your wealth of knowledge, everyone kind of asks you those questions. Give us a couple of them.
Sure.
Let's chat about them.
Yeah, probably one of the most common ones that I deal with within my family is the whole investor pay down debt question. It's kind of one of those timeless questions that trips up a lot of people. Like, I don't know, should I put my money in the market or should I pay down some debts? And generally it comes down to 2 main things. What's that expected rate of return if you do invest it?
Yep.
Versus how much are you guaranteed to save if you decide to pay down debt?
Yep.
So just a quick little example, you might have a debt that's got a 3% interest rate on it, so fairly low.
Yep.
And you might have a moderate aggressive risk tolerance where you think you can earn 6 or 7% a year in the markets. So what's the difference there? We've got the 3% interest on the debt.
Yep.
If you decide to pay down that debt more aggressively, you save yourself 3% in interest, and that's your savings.
Yep.
And that's guaranteed because they're going to charge you that 3% if you don't pay it down more quickly.
Yep.
If you decide to invest that money, now you think you can earn 6 or 7% with a moderately aggressive portfolio.
Yeah.
You might be able to achieve that. You might not be able to achieve that.
Yep.
Over the time frame that you're paying down the debt, you might only earn a 2% rate of return, and you would have benefited more by paying down the debt. So, it is a big question. A lot of it has to do with what's that difference in how much you expect to make versus how much you will guarantee to save yourself.
Yeah.
And how long of a time frame do you have?
And I think this is one of those things that take a look at how much interest you're paying on that debt, right?
Mm-hmm.
So if we're talking credit cards and you're paying 19-20%,
right, the conversation gets real quick, real short.
I can promise you there is nowhere I can guarantee you 19 to 20% guaranteed.
Yeah.
Like when you're paying it.
Take the cash savings on paying down the debt and then think about investing at that point.
Yep. And actually, as financial planners, that one of the first things that we're looking for is, all right, is there some debt out there that we need to be clearing up that has high interest rates on it, right? So I think that's a good one. Yeah, that does come up quite a bit. I get the question a lot where it's, how much do I need to retire?
Mm-hmm.
What number do I need to retire? And I think it's funny because a lot of folks think of it in that way, right? Like it used to be, I need $1 million to retire. I need now $2 million to retire.
Right. It's easy to conceptualize. You need this
Right.
figure to attain, and
I
get your
just need to
goals.
save and get there, and then I'm all set. What the kind of real answer to that is, what kind of lifestyle are you looking at in retirement? Because everyone's answer to that question is different.
Yeah.
$1 million may be able to do it. If
Yeah.
you aren't living on a ton, $500,000 might be able to do it. If you're gallivanting off to Europe and hitting 4 or 5 countries a year while you're traveling, we may need more like $3 or $4 million to do it.
Right.
So I find that to be an interesting one where everyone's kind of, all right, how much do I have to save? Well, what's life going to look like?
Right. And, for some people that dollar target can be good because they understand I'm going to reach this and then this is what my picture is going to look like.
Right.
And, hopefully it all unfolds that way with the markets, but
Yep.
you get a general sense.
Yep.
Yeah. I'd say the other big one from my family is refinancing decisions. It just,
especially right now.
Yeah, especially right now.
Yeah.
And I became a homeowner about 3 years ago, and then my brother-in-law and sister became a homeowner, and then my folks have a couple houses, and that's the one that always comes up. Is like, oh, should I refinance?
Yeah.
And recently, it's obviously been a big topic of conversation because interest rates are pretty much near the floor at the moment.
Yeah.
At least with the Fed, they are at the floor with mortgage rates.
Yeah.
The mortgage rates fluctuate a little bit, but don't need to get into that. So, I get the question, should I refinance this?
Yeah.
And, generally that's where we're looking at a couple of different things. One, we need to look at length of the loan. We need to look at what the payment's going to be under the new loan and how much interest savings you're going to get.
Right.
And there's just a lot of different factors that go into it that don't always make it a clear picture. So, if you had a 30-year mortgage that was at 4.5%, and now you've paid that off for 10 years and mortgage rates are now at 3%, some people might think, oh, I need to go get a new mortgage and go get it at that 3%.
Yeah. But
if you get refinanced and get another 30-year mortgage, you're resetting that clock, and now you're paying the bank the interest up front again. And maybe that's something that we need to talk through. Why lower the interest rate and bump it out 30 years?
Yeah.
Maybe lower the interest rate and get a 20-year loan that coincides with your current timing.
And a lot of times especially in the environment we're in today, when we're looking at refinancing for clients or having this discussion, a lot of it comes down to, all right, do you want to save interest on the back end of this?
Yes, please.
Do you need more cash flow today in your day-to-day life? By lowering your payment, are we going to avoid taking on other debt by freeing up some cash there?
Yeah.
Or are we comfortable paying, and this goes back to saving the interest, but are we comfortable paying what we're paying today, but we can reduce the amount of time we're going to pay on this loan?
Yeah.
We go from a 30 to a 15 year.
Yeah.
And a lot of times, if you need cash flow today, we're looking at refinancing out another 30 years and how much can we lower our payment? The 15-year, we may see in rates a lot of times that it is, do we refinance the 15-year and keep the same payment and just chop some years off the back end of this and save a little bit of interest? Or do we go to like a 10-year and really maybe up our payment every month and really drop down that interest on the back?
Right. Yeah. You're accelerating both. You're getting a lower interest rate and you're paying it back quicker. And, those are all things that kind of just the natural course of the economy has now put this refinance decision on your lap. And you're realizing all these other things that you could have been considering beforehand that now you're taking into consideration now. And it's kind of like this little perfect storm of, you're getting really into the in depth and making good decisions with a refinance decision. So, and then the last big thing that I always walk through family with is there's an opportunity cost. And that's the one that a lot of people always forget about.
Yeah.
If you're lowering your amount of payment. So say you went from you have 20 years left payments left and you're going down to a 15-year mortgage and you're paying more and you have a lower interest rate. Kind of goes back to our initial conversation where we said, hey, you're paying down debt at an aggressive rate. You're getting a guaranteed savings on that interest.
Yep.
But what if you're younger and you could deploy that amount that you're going to have in an increased mortgage payment because you're going from a 20-year to a 15-year and actually save that instead of applying that to your mortgage. Right. That's the opportunity cost that you could be missing out on and something that you need to think about and consider, not just, oh, the bank's not getting my money.
Yeah.
It's like, the bank isn't getting your money, as much of your money, but you could be using your money and making more money on that.
Yeah. And I think the big takeaway on that one is it's not as easy as, oh, interest rates dropped. should I refinance right in this moment? Well, what are we trying to do? Like, what's our end game here?
Yeah.
And doing out that calculation, see what the savings are, exploring opportunity costs if you're investing. What are we earning? How's the market doing? Those types of things are important.
Yeah.
Another thing that comes up quite a bit for me is I'll get a relative who changed jobs, and they always kind of ask, what should I do with the old retirement? Should I just roll it right into the new retirement plan, or should I just keep it where it is? What should I do there? And, I'm always a fairly big proponent of moving things out of a work plan if you have the opportunity. So if you have kind of a pre-tax qualified work 401k, for example, you can roll that out to an IRA. And the benefits of that are you're no longer handcuffed to what the employer plan was offering for your investment choices, which probably aren't terrible, but they're, very limited. They're in scope. The employer
has less choices or more choices. Generally, folks are going to go, I want more choices.
Right. And
expand my horizons.
Especially if you're looking to diversify out the portfolio and lower your risk and kind of put your eggs into different baskets. By moving into the IRA, you can invest in anything in the world and allow yourself that full diversification.
Yeah. And that really comes to like the next big question that you get around the holidays.
Yeah.
Hey, Tyler. Hey, Abrin. What should I invest in? I heard really good things about this stock. And you're like, okay, I see where this conversation's going.
Yeah.
Gold's the next big thing. Heard it all before.
Yeah. And diversification's always going to win out that conversation of what should I invest in. And so even in that work plan setting, right, you have your options there. And what I always tell people is you got to look at it, but almost 99 out of 100 times, I'm going to say, you should roll that out to an IRA and start to manage it, whether you do it yourself or have someone help you. You're just going to have better options. Leaving it at the old work plan, you're not going to be putting more money into it. You can go in and make some changes to where you're allocated, but you're still limited to what you're offered. You could move it to the new work plan, but you run into the same issues you have at the new work plan that you had at the old work plan with your investment options. They may be a little different, but generally it's going to be a smaller list. So, exploring rolling out to an IRA, I always think is beneficial, and it allows that diversification, because every time someone asks me about a stock at Thanksgiving, I tell them either listen to this podcast and don't listen to our stock picks at the end. No. Just kidding. And that's exactly it. Picking one winner is so difficult to do. It's nearly impossible. And any type of research around diversification will show you that every year there's a different winner in the stock market, at least stock types. Yeah. And trying to figure out which one that's going to be.
Yeah. And I always think about it from the standpoint of being a fiduciary. Right. Like, this is my family. I'm not going to advise them any different than I'm going to advise a client. Like, this is what I believe is in your best interest to do. Yeah. Don't pick one or two stocks to throw all your money into. And, maybe you are right for the first 3 months and the stock goes up. Maybe you're right for the first 6 months and the stock goes up. Maybe you're right for the first 2 years and the stock goes up, and you're rubbing it in my face as the financial advisor in the family. Yep. And, I'll just be like, okay, well, when do you get out? Yeah. You keep watching it go up. There's volatility along the way, but you're still so sure. And then eventually something catastrophic happens. Yeah. Think earlier this year, COVID. So many stocks plummet. Not all of them do, and maybe you got lucky and you picked the right one. But do you really want to be the person that got, that one out of who knows what chance, and to be super lucky when you could actually use statistics and reason to diversify your portfolio and provide some insulation and guard yourself from risk?
Do you want to gamble or do you want to invest?
Right. It really is a gambling question,
and that's what's coming down to.
And like, I'll go to the casino. Like, we can go gamble, but I don't want to gamble your life savings.
And in that, when you go to the casino, you're gambling, right? You've made that decision.
Oh, yeah. Blackjack, 50-50 chance. Yeah. You know the rules.
I find that sometimes in investing, people believe that it is not gambling because I'm doing it in this investing manner and I'm doing it over a platform and all. Yeah. If you were just selecting one stock and putting all of your money into it, you're gambling at that point. You're not investing. Yeah. It's completely speculative and is fairly reckless way to invest your money if you're looking over the long term.
Yeah. But hey, if you want to have some fun, I'll talk stock picks and just be like, you can invest what you want to lose in that. Yeah. And then we'll talk fun. And I'll have that conversation with family members and just be like, yeah, that stock, I like the company. These I've done a minimal research on them in the past and enjoyed it, or don't like it for this reason, and talk through that. But still, it's not a sound long-term financial strategy for investing.
No.
It's just
Just
one of
more
those
conversation, I think.
Yeah, one of those dinner table conversations.
I get this one a lot. Tell me if it comes up with you. With these new high deductible plans people are being offered at work, what's an HSA and should I use it?
I don't get that one, but that's the one that I bring up to family members. I'm like, hey, do you guys have a lot of health expenses?
Yeah.
Like, you can tell me, I'm family. Like, oh, no? You use this great tool called an HSA. This is the only money the government will never touch with taxes if you use it right.
So, and Abrin just hit it. Anyone who doesn't know what an HSA is, it's a health savings account. If you have a high deductible plan for your health insurance, you're allowed to use an HSA to save money for medical expenses.
Yeah.
But it is the only account that acts in the fashion where they let you put pre-tax money in.
Yeah.
If you spend it on qualified medical expenses, they don't tax it on the way out. It's the only account that doesn't see any taxation. It can be a powerful tool, and the money you put in there, they allow you to invest. So it can even grow while it's sitting in there every year. So if, like Abrin said, if you don't have high medical expenses, certainly do not write off a high deductible plan with an HSA.
Yeah. And if you, with that plan, generally your premiums are lower. And if you can save throughout a full year with minimal medical expenses or none, then by the end of that first year, you might have enough money saved up to pay for that deductible or pay for the maximum out of pocket on the plan. And then you're back to square one,
And it's great, not like a flexible savings plan, which a lot of people probably are more familiar with.
Yeah, I call that one the evil cousin of the HSA.
So, at the end of the year, any money you have left in the HSA, they don't take it from you.
Yeah.
You can roll it over next year.
it.
You just keep adding on. Where that flexible spending plan is going to force you to pay it out.
Yeah.
Or you lose it. The other nice thing about the HSA is you can spend it on your family. I know just personally, my wife. I have two daughters. Both of them I had HSAs for. I planned accordingly and put money in there. And when the bills came for kind of the expense of their births, paid it off with my HSA, tax-free,
nice.
and was happy about it. So very powerful tool. So if you want to learn more about this is one of those things. Reach out to Abrin and we can talk to you about it. But an HSA can be a powerful tool in your financial plan.
Definitely. Yeah. Why don't we go switch gears and go? Well, what financial planning tool are you thankful for this year? And if you don't have one, I can go first because I've been thinking about mine for a while.
Yeah, this wasn't on the script for the podcast. Let me my favorite financial planning tool, and it's probably because I'm younger, but I love the ability to use a Roth IRA.
Nice. Okay. Yeah, you stole it. I'll think of another good financial planning tool.
A Roth IRA. I know I talked about this in the last episode, but I'll just kind of run through real quick for folks again. A traditional IRA works just like your qualified pre-tax work plan. You put money in today, they give you a tax break on it. It grows deferred until you get into retirement. When you pull the money out, you're taxed at that point. The Roth IRA works in the opposite. We're going to pay taxes on the money we invest in there today. It's going to grow throughout, and as long as we're 59 and a half and we take out money out of that Roth IRA, it's going to come out tax-free, any of the growth on there. But there's some other nice things about the Roth that I love. One, you can always touch the principal that you put into it if you ever need it. Believe me, I'm not advocating to touch your retirement accounts. I'd rather sell a kidney than start tapping into my retirement accounts. But if you needed it, you can always grab the principal there, no penalty, no taxes. So it's almost like a double savings account in some sense. And when you get into retirement and you're 72, like we talked about in the last podcast, they're not going to force you to take money out of this thing. You can let it grow. And ideally, that'd be the last money you ever touch. It can grow out, and it's a great estate planning tool down the road. So if I had to pick one that I was really thankful for, it's the Roth IRA, and you're welcome. I stole that.
Yes, you did. I was really trying to go first. It's such a good one. But while you're talking, I did come up with another financial planning tool that I'm thankful for. And I'm going to go with high yield savings accounts.
Yeah.
It's another one that I personally utilize a lot.
Sure.
High yield savings accounts is just what it sounds like. It's a savings account that's liquid and you earn more than kind of your traditional savings account.
Yeah.
So interest rates, like we talked about with mortgages, are floored, and that means that no one is earning anything in their cash sitting in their savings account, which a lot of people know when they look at their statements and they're like, oh, good, I made another 3 pennies this month.
Yep.
That's because a lot of banks out there are only giving 0.01%, 0.1% in interest, and that's just super low. It's practically nothing.
Yeah.
You look at the pennies and you laugh.
Yeah.
So
I almost rather put it under the mattress at that point. Don't do that. Don't do that.
Yeah, at least you get a little something. But with a high yield savings account, you actually get to earn more than that. And there's a bunch of different banks out there that offer these. And two that are notable for me are Ally Bank and Citibank. They tend to be in the top tier of ones that give the highest interest rates. And right now they're giving around 0.6, 0.7%. So, obviously that's still not a lot, but it's much better than it being that 0.01% or that 0.1%. You're multiplying it 60 to 10 times, 60 to 6 times more. It's a lot. That's a lot.
It is. And they've come down quite a bit.
They have come down quite a bit over the past year.
Mostly because
the interest rate drop.
The Fed's trying to save the economy and keep things afloat.
Yeah.
But
I'm just glad I can be out there and know I'm getting the most for my money.
Yeah.
But also have it be liquid. That's the other big thing is if you want guaranteed interest rates, the higher the guaranteed interest rate, the more restrictions you're going to have on that money. So, people tie up money in CDs because they can get higher interest rates than their cash savings. And, you can't touch it unless you want to pay a penalty to touch it early. That's why they have the lengths on them.
Yep.
Or if you wanted an annuity, that maybe a 5-year annuity that gives you 1 or 2%, it's a higher interest rate, but now you can't touch the money for that 4 or 5 year period that you're getting it. So this high yield account's a good balance of able to go get a higher rate and have it be liquid and to get the insurance. So don't forget that these are still FDIC insured up to $250,000. So
good point. And they're great, right? So they tend to target a 3-month CD, fully liquid, whatever that rate ends up being. Like I said, it's come down, but it's still always going to be more than your traditional banks savings rates, mostly because these are online lenders or online banks that don't have the overhead of keeping physical locations, so they can get these nice things. Yeah. But it's also a great place to park some cash because this is another question that comes up at Thanksgiving all the time. I'm looking to buy something in the next 9 months. Where should I invest my money right now so I can have it available to me? And a lot of times my answer to them is you probably don't want to invest that money if you need it in that short of a time period, right? Yeah. Because the market could do anything and you could lose money when you're trying to take this out. But the high yield savings account is a great place to park it. In the meantime, earn just something on it. So it's not sitting there doing nothing for you. But you have the full liquidity. You can access it. In 9 months, you got at least what you put in there, plus whatever you're making on that interest. So
certainly.
That's a really good one.
Cool.
I'm gonna throw another one on there that's kind of in the Roth realm a little bit, but for education savings, and that's a 529 plan. I have 2 kids, as I mentioned. The 529 plan, it's very similar. It's like a Roth, but for education. You're going to pay your taxes on what you put into it today. You can always access the principal and not be penalized or taxed on it. But any growth in there, if it's spent on qualified higher education expenses, which the IRS will break those down for you, or a good financial planner can tell you what those are. And that money can come out of that account tax-free. Powerful tool for saving for college because when we look at inflation rates on college these days, it's almost astronomical. Seems
not almost, it is astronomical.
It's mind-boggling to think. There's no way I'm going to save in the next 18 years $350,000 for my kids to go to school. But if I can invest it along the way and get some tax-free growth, that makes a big difference.
It's working on your side.
Yep. The one big caveat in that is if you do access that money for things outside of higher education expenses, you're going to pay that 10% penalty. So if your children go
only on the growth, though, right?
Only on the growth, right? So you can always touch the principal, but only on the growth. Now, if you have kids who just get to 18 and say, I don't want to go to college, and you've been saving in this account, it'd be a bit of a pickle because now all your money is in this account that's set aside for qualified higher education purposes. But if your kids are going to go to college, it can be a really powerful tool. You can also change the beneficiaries on them. So if you have 2 children, one of them gets a scholarship, you've been saving for both, you can change the beneficiary to the second child on both of the 529s and use the money for them. You can use it for yourself. You can change it to a grandchild down the road.
Imagine you're saving all this money for your kids, and they're like,
Yeah.
I'm going back to school. You guys can fend for yourselves. I'm taking this 529 money.
I can tell you that you don't have children yet because you don't realize things like that happen. But I do. It's a great tool. I like it. You'll notice a theme in the things I love, and most of it is tax free.
Yeah.
Those tend to be my favorite.
Nice. Well, being on the thankful side, I think people would be thankful if we wrap this up, since we could go on forever.
Awesome.
But we'll be back, obviously, with more podcasts to come.
Yeah,
But we do have to run through the stock.
I was going to
game
say, let's
real
not
quick.
Run out of here before we talk about how the stocks did this last 2 weeks.
You just want to put your W on the board. I know.
I do think Disney outperformed Monster. You're the one who pulled up the numbers. So.
Yeah, so Disney had a nice little run of 3.4% over the past 2 weeks, while Monster had they were doing great. I don't know what happened. They just fell apart right at the end. No, I'm just kidding. They were pretty lackluster this 2 week period, but they were only up 1.3%. So, Tyler, W to you.
Thank you, sir.
I would tip my hat, but now we're totally tied. Where I won the first one, we tied last week with 9% each, and now you're up. So,
sounds like
one win to one win to one tie.
Sounds like Monster needed a little bit of a pick me up. What stock you going with? What stock you going with this session?
Oh, that's a good one. That's a good question. Let's see.
I'm gonna go with AT&T.
Okay.
Coming into the holiday season here, 5G seems to be a thing people are paying attention to. Everyone hopefully is buying new phones for the family over Christmas. I'm going AT&T.
All right. Let's see. Clearly, I didn't put a lot of forethought into this.
That works in my favor.
Yeah, it does. Well, it kind of doesn't, because I'm only thinking of big names right now. I kind of want to keep it fair. I'm just going to take the W. I think Walmart is going to outperform AT&T.
Yeah, that's a good
they've
one.
been obviously killer throughout the pandemic, so I'm going to go with Walmart. I feel a little cheap about it, but a W's a W, so we'll see who turns out.
Listen, they rolled back prices. One of the things that was interesting through the pandemic is they kind of picked up their delivery.
Yeah,
especially through March, which would play well if
I've had a lot of good conversation with friends about Amazon being such a titan because of their delivery power.
Yeah.
But we get into these battles over can Walmart take away some market share? They've got all these warehouses everywhere. It seems like there's a good argument for it there.
And I don't want to kind of tout your stock here because I'm hoping you lose, but talking about delivery, Walmart has a little bit of a leg up because they have all these physical locations so close to everyone, where they have this infrastructure to do really quick delivery.
Yeah.
And if things are trending the way they are, coronavirus wise, and
just in general, Cyber Monday sales every year they keep getting bigger.
Seems like
even before the pandemic. So,
but hopefully they have a couple weeks here where they don't do too well, and let's go AT&T. I want to thank everyone for joining us. Like I said, find us on YouTube. Check out all the podcatchers. Subscribe, like us, tell some friends about us. I promise there'll be some episodes where Abrin's not even here, so I guess that'll be fun.
I can't wait for the one that you're not here.
Well, I'm gonna go try to stuff my face with more turkey.
All right. I hope everybody had a nice Thanksgiving, and we'll catch you next time. The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Thank you.